Hello everybody, Vulcan Trader here, and today we're going to show you how to use moving averages to predict a stock market recession. And this is important to know, whatever type of trader you are, if you're anything besides a day trader, you're a swing trader, position trader, long-term investor, or, buy and hold index investor. Maybe this will help you out for timing, know where you're at in the longer-term market cycle to know the direction that you should be going. So here we have a monthly chart of the S&P 500, which is the 500 largest stocks in the stock market, and I've got my blue lines a 10-day moving, or sorry, 10 period. I should have said 10 period, so each one is 10 month, and then 20 period moving average here. This line, and the green one is the 50. The red's the 200. You're not gonna really use that here, but so I'd say anytime you get so if we zoom out here, so you get at every time frame, whether it's a daily time frame, weekly time frame, monthly time frame, you get consolidation and then you get trending. Okay, and stock indexes pretty much always go up over the long term because of inflation, fiat currency, the U.S. dollar being the world reserve currency, etc. But so right here, consolidation just means, it's going sideways like this, okay? And then trending means it's going either in a direction up or down. And they say markets trend maybe 30% of the time and consolidate or go sideways or not trending 70%. I'd say it's probably more 50-50, but I've read books where they say it's 30-70, but from what I see here, it's closer to 50-50. And so how we would do it, real simple way, is use this 50-day moving average, or sorry, 50 period moving average, so it's 50 months. And if it's the price is above that, then you know that you're in an uptrend on the very long-term time frame, okay? So maybe say you would have been going long right about here somewhere, and once we break, it's really once we break through the all-time highs, and then it continues up and it's still up, so we're still in an uptrend. And once you break through this 50 month moving average right here, then you know you're in a recession. So if we take a look right here, so you have the S&P 500s moving up above the all these moving averages, broke down below it, or it's whichever moving average it respects, or any stock respects. It's not like there's some magic number for a moving average or which one you should use. It's just which one it respects, and that can vary from stock to stock or an index, whatever you're using. But I've found that the 50-day shows you that a long-term uptrend is still in place or broken. So see right here, we got, okay, so it started moving down. Actually, this one you got at least from like 94. Let's see, you broke the 20 here. You kept above the 50 from 8. Let's say we look right here. Okay, so say if you would have bought somewhere in the 80s after you're above the 50-month moving average, about 83-ish right here. Okay, and then you never sold until it broke through that, or you had a close below it. Close meaning, see right here, the thick part of the bar went below that. That's a close below it. Whereas right here, the price touched it, but it didn't close below the green line, our 50-month moving average. So you keep going, and then whenever right here in June, or let's see, or March, March 01, that's when we had a close below it. So you just sold there, and then whenever after you have that, you have a long-term uptrend on any time frame, then there's going to be consolidation, meaning it's going to go sideways. And a lot of people will be buying up here like, oh, stocks are awesome, they always go up, and which is kind of the same type of mentality we're sort of in now. It's probably not as bad as it was in 2000, and then what do? They go sideways for a long time. So right here, if you would have bought, after it looked like, it's just they always go up, no, because they went sideways for till February of 2013, you would, or somewhere around this neighborhood, beginning of 2013, that you wouldn't, say if you would have bought here, you wouldn't be break even for another, 12, 13 years, something like that. So stocks don't always go up. And so it would be just buying, holding, and not getting any return really during that time period had you bought here. But I mean, you'd probably dollar cost average the whole thing if you're buying indexes, but you're not really going to see returns on all your purchases until this point. Then we're back now currently in a long-term uptrend on the monthly time frame. We're sitting above this 50-month moving average, and you can see here it went back down, almost touched it on our most recent correction, then it bounced back up. And so if we keep going sideways more, this 50-month moving average is going to get up closer to it. And if it rolls over it, then probably that'll signal the entering of the recession. And because we've been in a long-term uptrend, stocks won't perform going good over the next decade or so. It'll be something similar to this. So you got the long-term uptrend. We, had it. I mean, I guess you could say since 2009 you've been in a bull market, or you'd say since 2013, depends on how you look at it. But anyway, roughly 10 years we've been in an uptrend from right here to right here. So maybe the next 10 years or so you'll get something like this, where maybe it goes down for a couple years, or it goes down. You have a bear market for a year, then you got a 5-year bull market, and so forth, and get a couple pullbacks or recessions here, some sideways action, and I'll show you the same type of thing on further back here. So S&P 500 on TradingView only goes back to 71, so we can kind of so I'm gonna go look at the Dow Jones. Before I do that, let me go to that. Actually, no, we'll go to the Dow Jones first, and then I'll go back to this other idea I was going to show you. So if we go all the way back to, so similar things you've got, so people don't have a very long memory, but so similar time frames of a long-term uptrend would be right here through the 50s. We're above the 50-month moving average pretty much the whole time here, from 1950 to about 62-ish, something like that, which is a real strong bull market. And before that, what do you have? You have sideways consolidation, which just happens in every time frame, no matter where you're at. So stocks went sideways for a really long time, then they go up for a while, and you kind of had a pullback close, and then it went back up here. But then after this, long bull market here of the uptrend, you only had one pullback below that moving average that whole time. And what does it do? It goes sideways from 66 to 82. It's a super long. What is that? It's like, I don't know, probably 15 years or something. I don't know. I'm sorry, I'm bad at math on the fly actually sometimes, but so somewhere around there. But pretty long time. You got a consolidation. Then after that consolidation, and a lot of people give up, like, oh man, they probably think, oh man, I've been buying stocks, and they just kind of sit there and hardly go up at all. And then finally you get a breakout. After one, you look like, oh, it looks like I hear 1, 2, 3, 4, 5, 6 times the charm. In this case, breakouts fail a lot of times, and then once it breaks out though, and it continues and it holds up, you get an awesome move. So check it out. Check out the 80s to the 2000s here. Never broke the 50-month moving average on this whole time throughout that. And on the Dow Jones moving average is just 30 stocks that have been around for a long time. I'm using this one because it's the oldest index, so we can look back further, and just 30 random stocks, which is a good enough sample. Or they pick them and change them randomly, I'd say. But it's a good enough sample size to show us the general market, though. So you get a long-term uptrend for 20 years here, and then what happens after that? Finally, we break our 50-month moving average and consolidation right here. So you got the sideways action for a while, and then get a breakout above that around this time, and the uptrend, like I was saying. And then you got the same thing all the way back here. So let's see how far back we can go. And so we got sideways consolidation from 1915 for 10 years, and then boom, goes up. Huge bull market. This is the Roaring 20s. It's right before the Great Depression. This is one of the awesomest bull markets ever. Show you one other example like this, where it's so going up so hard and so fast that it just went hugely away from even the 50-month moving average. Maybe you would want to use when you get that far, that hard of a move, you want to probably use a little bit shorter term moving average. In that case, that's where pick your magic line, or your moving average that is a different one, a little bit closer, to lock in maybe some more of your gains, whichever ones it's respecting, but it isn't really touching. So this blue one, it's still touching some, so you don't want to use that one. You say, okay, this 21 has never touched this whole time, but it's still got some space away from it, so I'm going to use this one. you just sold, maybe somewhere around here, or you could even move it up closer if you really wanted to this one later, because it started respecting this one from, all this time. So you pick that, close it out, and then it, just drops crazy hard. Instead of having sideways consolidation, because the move was so hard, far upward and parabolic, then you have a, huge bear market where it doesn't really go sideways until it pulls back down. It would be something similar to maybe Bitcoin would be a good example of this. Not to say it couldn't recover from it, because I'm bullish on Bitcoin, as y'all know, but just to give you an example of, something parabolic, we'll look at it on the daily chart, would be a similar type of move to this. So you get a real parabolic move, and it stays up above the shorter term moving averages, the 20 and the 10, and then once it breaks those, then it breaks down. The 50 actually were expected for a while, but eventually goes really parabolic. Then you want to maybe use the closer moving average, and then it has like an 80% drop after that. Okay. So, there it is. So from here to here, so it has a really big, like 80% drop, even harder than if, it hadn't gone up as far. The harder the move upwards, the harder move downwards. The same thing in the roaring 20s to the Great Depression, like we saw right here. You have a huge parabolic move, and then you go into the Great Depression. And a similar move like that on the index that you would find would be right here, the dot-com boom of the 2000s. It's crazy on an index, and then what happens? Pulls all the way back down, drops 80%, and then it's got to go sideways for a decade before it starts breaking out again. And then now the NASDAQ is actually outperforming in this most recent bull market after doing nothing for a little over a decade after its dot-com boom. So if you had bought the NASDAQ after it, had gone up here, then you'd be thinking, oh man, it's going to do great. Nope. So I'm trying to think what else we do here. I think that's about it. So that's how you use moving averages to predict a recession and get a kind of a longer term view of where we're at in the market cycle and the stock market as a whole. And in my next video, I'm going to show you how you can kind of use this on different asset classes to compare them and say, okay, well, this one has been in a consolidation for a long time, breaking out, and then stocks in this, like we're talking about, have been a long-term uptrend. So if they break that moving average, they're probably going to go into a consolidation. So you want to switch out of stocks, or being as heavily weighted in stocks at least. If you're playing the indexes, because for example, you could, Sorry, I'm talking too much here. But yeah, how to switch into a different, my next video is how to switch into other asset classes whenever those have been consolidating and will probably outperform compared to another asset class. In this case, it's stocks. So thanks, like, subscribe, and hit the bell, and we'll talk to you later.